Blake, one of the things we talked about CPI just then, but one of the things that came out after that was the idea that the Federal Reserve could go 100 basis points. Sticky inflation. We talk about inflation in a second in a subject very close to your heart. But we're looking at the Wall Street Journal now, Nick Timiraos. The idea that we were in a blackout period now. There's no more Fed members who are going to be speaking up until next week's Fed meeting. So it's really down to him as the mouthpiece of the Fed, effectively. He came out with an article recently that said the Fed were going to raise by at least 100, by at least 75 basis points. The markets, if you put it now, are running about a 25% chance of 100 basis points. So they are opening the door for 100 basis points. The default position is still that we're going to get a 75 basis point hike next week. But yeah, Nick Timiraos, we've got our eyes on his Twitter feed, any kind of articles coming out that, just to see if he does say, it's more likely to be that, because then the market would obviously discount that. You're going to see the terminal rate moving up, which we can talk about in a second. The dollar's going to rally. The equity market will take another leg lower probably from that point. But that's what we're debating here. So knowing what we know now, we're after that CPI number that we saw, and we can talk about in a second, are you in the 75 basis point camp? Are you in the 100 basis point camp? Yeah, what's your view there?
75, and very unscientific. So let me just make sure I throw that one out there. No, and here's the reason why, and we're going to talk about inflation here in a moment, but really the number was skewed by rents, and I do happen to live in one of the hottest real estate markets in the United States, and I know rents are actually starting to come down here, and so I think it is a lagging indicator. So I do, and again, I don't want to get in the inflation conversation just yet, because that's coming up next. However, I will say that I don't think the Fed's actually going to. I don't think the Fed's going to move by a full percent. And here's the other reason why. Nick is also known as the Fed whisperer, Chris. And so if he's out there talking about it and we don't get it, and we only get a 75 basis point hike, the market's going to celebrate that. I mean, as crazy as that sounds, isn't that crazy? I know we said that last week, but it's crazy.
Yeah,
right?
I know. But this is the thing, right? So if you go out to people who are new to trading, and this is the conundrum, right? So you go out, we get a 75 scenarios, think hypotheticals here. We get a 75 basis point hike from the Federal Reserve. The day after that, we get the Bank of England coming out, and they raise by 50 basis points. And the pound just goes whoosh, right? Or just goes completely nuts. It's about understanding what's being priced in. So we're pricing in an element of 100 basis points. The Fed goes 75. The dollar effectively sells off in that situation, right? The Bank of England only go 50 basis points when the market's pricing in a chance of the 75 basis points. Obviously, the pound falls in that situation. So in this 24-hour window, you could see some major moves, and everyone's going to be saying, hang on, they've raised by 75 basis points, but the dollar's sold off. Why? It's really about what's being priced in. So you've got to understand what's being priced in. And actually, for me, what's more important is what the market price is the terminal rate.
And we're gonna get to that point in just a minute. And I'll tell you, Chris, I love FX, and FX is the place to be. We talked about it at the beginning of this year. This is the market you want to be in. And we're talking about it. We're in it. We're trading it, and I'm glad to be here, and I hope you guys are too. So let's talk about inflation. And I gotta ask the question, Chris. I mean, everybody was calling the top of inflation. I mean, the market was leaning into it. If you sit back and
frustrations.
Oh my gosh! I mean, everybody's like, "What do you mean? U.S. equity markets are down 4%. Nasdaq was down 5%." Why? And it was really just positioning. Everybody was thinking that the top was in for inflation. Everybody's trading into it. And we were in that mantra. We were talking about the top might be in for the dollar, and we were there. And what happened? We got this really hot August print. And I got to ask, is the top in? I mean, because the rents was a big number. It was also some food items, groceries, but we have crude that's come down, and price at the pump has really come down. So I gotta ask you, do you think the top is in for inflation now, Chris, or are we still going to have months ahead of pain as consumers globally?
It just feels anyone just making that call has been burnt so many times, but I don't think you're going to see a huge amount of upside from here, to be honest. And we're really focused on what was going on in headline inflation, but it turned out that the one measure that we really want to look at is the sticky prices, the core inflation read, which was about 40 basis points above where the market was looking for. You make a really good point that it was really the sort of shelter components and the owner equivalent rents that really sort of drove that. Rents were up.
Medical costs.
Yeah, well, rents were up 70 basis point month on month, so that sort of drove the moving core. So look, I just don't think, the concern that we had was that the market was just saying, look, we need to see the peak inflation narrative play out in this print. We didn't see it. And there was a lot of frustrations. People had to unwind positions. The market went down, and you've got a lot of optionality that goes through. The market suddenly, dealers were short gamma. They were having to hedge by selling futures ahead of OPEX this week, on Friday. And it was just a lot of positioning that unwound. We saw volatility kick up. The volatility targeting funds were dumping positioning left, right, and centre. It was just a bloodbath coming through. That positioning was just got an exercise in understanding flow. But I think there was just at the heart of it was this frustration that people were positioned for a peak inflation narrative and it didn't come. And the core number actually was going the opposite way. So I think what's really interesting here is that the Fed, in some people's eyes, would say, have increased the capabilities or increased the possibility that they will raise rates until something breaks now. That they will not just raise rates and cause a recession, a shallow recession, but they will actively welcome a recession. That's what probably changed in the market's eyes, I think, based on what we saw from core inflation. So there was a psychological change that I think still needs to play out in markets. I think one of the other things, if we take a switch for focus, was that we did obviously see the dollar rally. And there's no better place to hedge yourself than in the dollar. So we're talking about the Bank of Japan because really, the Bank of Japan, they stepped it up yesterday. Their Bank of Japan really, really stepped it up. And the dollar was the place to be. You had to be in dollars. Equity market drawdown, buy dollars because it's the best hedge you can have against drawdown. It's got the most inverse correlation against equity markets. So equity up, buy dollars, and it's sort of self-perpetuating loop. But of course, we saw dollar yen pretty much touch 145. The Bank of Japan, you saw the finance minister coming out. You saw the key currency member of the Bank of Japan talking about intervention. This idea of checking rates came through on the wires, and everyone went, whoa, this is really it. This has preceded intervention before. They are calling up the banks and saying, give us your bid on dollar yen at the moment. What are you good in size? And everyone said, this is it. We've got to get out of our yen shorts in this situation now because they are really meaning business. Does it mean business for Mr. Morrow, Mr. Yen? Or is this a buying opportunity in the yen crosses here?
Well, it means I believe it means business because you gotta go back to, this harkens back to the 90s, when you talk about getting, rates checked by the BoJ, the MOF. And when you have Suzuki out there, checking rates, they're meaning business right now, Chris. And this could really shift the gears, in my opinion.
Is that a pun?
Because
is that a pun? Suzuki.
It is.
Anyway.
It is a pun, but it could shift gears here. The reason why I say that is because the yen has not been correlated with risk at all.
No,
for and for good reason.
It's been driven by the bond market, so it's just a bond proxy, right?
Yeah, it's just yields go up, and I mean, look, you got 30-year yields that are touching trend highs. I mean, you got the 10-year yield doing the same thing. Yeah, well, of course, you just buy the dollar yen. But this might actually shift the narrative where the yen becomes more of the risk-off proxy, and where the dollar and the yen start to share some of those, some of those traits like they have in the past. Because people now start to get worried. Well, maybe I won't be buying, all dollars. Maybe I need to be a little careful with owning dollars up at these levels. Maybe I'll just buy the yen because I've got the BoJ and the MOF holding my back. So that's kind of my thoughts, and I'm glad I'm actually buying and getting long yen at these levels.
Yeah, they've stepped it up. I still think we're away from intervention personally, but what they've done is they've gone out to the street and said, you want to hold a big yen short position? Think twice about that right now, because you know what? If we come out and we start buying yen, we start selling our reserves, you're going to see a 400-point move off the bat to the downside. And do you want to be involved in that? Because there's going to be some massive slippage if you are. So what they've done is they've caused a massive element of doubt in people, hedge funds especially, who have been shorting the yen for carry purposes. Volatility adjusted carry has been the strategy du jour. Everyone loves that right now. It's been the best performing strategy and the yen's been right at the heart of that. They have just really gone out to the street and said, do you want to be involved in that vol adjusted carry trade? Think twice about that. And that's really, they planted a seed of doubt. And I think that's going to ward off a few people. So, yeah, well done to them. But I still think there's going to be people looking to buy dips for now.
Let's talk about buying dips, but let's talk about different markets. Let's talk. Right, yeah. Great segue, Chris.
Yeah, it was.
You're good. You're really good. You're really good. I'm going to talk about risk markets, and I don't want to talk necessarily all about the S&P. I mean, I want to talk about all other markets. If you remember 2 weeks ago, Chris, I kind of built the case about how the markets might stall at the 200-day moving average, but it's not just the S&P. It was the NASDAQ, the DAX. We looked at the CAC 40, or we talked about it. We talked about all the other markets. So I want to talk about the markets broadly because we have seen that correction, and we are going into a kind of a tricky area or tricky time in the markets. Seasonally, you want to be buying usually risk sometime in November, but this fall, it's like, do you buy? Like, if I had to ask you, where's the next 10% move? Is it higher or lower from here? That's the debate. And it's not necessarily directed all at the S&P. It could be, at the DAX or the CAC, whatever risk assets you want. But we have rates going up globally, right? We have inflation that's going to run, where everybody's bracing for a very, very tough winter, especially in Europe. And, we still have a conflict happening in Ukraine. And, everybody's got their rate expectations going up globally. But how about, if economic data starts to weaken, we start to see employment data worsen globally, is that going to be a trigger for rhetoric to ease off from all these central bankers?
I think the Fed wants
so
this.
It's kind of tricky here. What do you think?
I think the Fed want the recession now. I mean, they need to do something. Something's going to break further down the line. They're going to raise rates, and they've seen that with inflation. If you put a Morrow metaphorical gun to my head and said 10% upside, 10% downside, what's the most likely scenario? I say downside right now. Why? Because as I talked about there, I think the Fed actually will welcome certain softness in the labour market. I think they're going to cause something to potentially break. And I think your reserves are about to fall quite precipitously as balance sheet reduction comes through, and markets have been very well correlated to that. So I think for me tactically, there's probably more likely we're going to get downside than we're going to get upside. But I've got an open mind and I'll react to that. That's my hedge against that scenario. But that's where I think it is.
So they're trying to engineer tighter fiscal conditions or tighter financial conditions, right. And one of the levers is the equity markets, right? Risk.
The concern you've got as well is the dollar, right? So as the dollar strengthens, it has this kind of effect into global central bank balance sheets. So as the dollar goes up, central bank balance sheets fall, and effectively that tightens financial conditions, and it impacts emerging markets quite negatively as well because of the dollar liabilities. So I think we're at the centre of this. It's not just real rates and terminal rates, but it's the dollar. So if the dollar rallies, nicely from here through into 115 on the Dixie, then I think risk goes down. So that's probably the one of the aspects that I think everyone should have as a central focus is what's happening with the dollar. So liquidity is coming down. We know that. But I'm not saying we can't rally 10%. I just think if you're going to say which one is more likely, it's probably downside. Interesting. Put a comment in the comments field. I know a lot of people probably share my views. A lot of people would disagree. Put a comment in the comment field. Let us know what you think in terms of where you see the most likely scenario. I'd love to hear what you've got to say.